This video is a 2025 review of what has been happening in my account and in for my money management business. So I want to go over the detailed stats for the year and everything I did right, as well as everything I did wrong and the lessons I learned from it, because there's quite a few lessons obviously from any year that you can kind of learn from, especially a tough year like this with all the tariffs and whatnot. And I will also obviously show you my broker statement, some graph analysis for past opportunities that I take and didn't take. So let's begin with it. And sorry, actually forgot to mention, my name is Eli. I'm a professional option trader. I do manage about $9.1 million in family capital. So let's begin with the detailed stats and everything I did right. So the return for 2025 is 25.93%. I've had only one loss this year. It was on a gold position, and the average duration for a position is 14 days. Average position size, I collected about 5.5% of the total capital in premium. On average, some of them a bit more, some of them less. My average margin requirements per position is about 24% of capital. My Sharpie at the end of the year, this year is 2.58, and my biggest drawdown was about 4% of capital actually. Overall, I think, or actually this is unrealized. I think realized was closer to like 2.8%, so much lower. And the month with no activity is March, half of April, and then the entirety of October that I didn't trade due to the tariffs, the China situation. I didn't want to have anything to do with the market, especially because I trade commodities for the most part. I sell options on commodities, so it's a bit problematic. Now for the Sharpie and for the yearly return, I will show you a broker statement in just a few minutes once we go to the next slide. Now what I did right this year. So I was patiently waiting for AAA opportunities, which is a big thing for me. I took my time, looked for the best opportunities, and I capitalized. Now I reduced risk by being in the market for only 146 days in total out of 365 days that you can have exposure to the market, including weekends, of course. So I've had no risk exposure to the market 60% of the time, which is really good. So basically 60% of the time my money was just sitting in bonds. It's sitting in bonds all the time basically. And then obviously when I sell options, I don't need any of the cash to trade. It's only margin requirements. So all 60% of the time I've been basically at no risk at all, no exposure to the market, only to the treasury bills. I only followed fundamentals to make decisions, which is a really big one. It's a tough one, especially it's a tough one to follow because sometimes when things go bad, you really don't just want to exit the position. But sometimes you can just have a bad timing when you enter a position, and it happened to me a few times this year. But fundamentals have stayed pretty sound, and obviously I've ended up profiting in most cases. I've always had a plan, and I made non-greedy decisions, which is really important for myself. In this business, as soon as you make a greedy decision, it has a massive chance of just spiraling down and becoming a bigger and a bigger part of your decision making, where you don't make the decisions based on fundamentals or anything that's gonna make sense. It's only based on greed because you want to make more money or show a better return or whatnot. So this is something I pride myself in, and I always make sure that I double and triple check myself that my decision is just based on, hey, this is the best possible step to take right now, or decision to make right now to preserve capital long term and stay in the game. And the last thing is I kept it simple. I think this is also really important. I didn't try to overcomplicate. I didn't try to add a bunch of indicators, a bunch of whatever to my strategy. I kept it simple. Something I've known to do. I guess my entire trading career so far has been 11 years of like profitable trading, proper trading. And over the past few years, it's been with quite a bit of capital as well. So let's go next and see everything I did wrong and the lessons I learned from it. Number one, I avoided directional opportunities. I did end up selling or making money on two directional opportunities. but I avoided basically all of the other ones. The biggest reason is because I really only have a lot of experience with selling strangles, right? And this year has been pretty tough for that. Things obviously were much more directional. So for me, it was just kind of like, mastering another tool in my toolbox. But I did end up opening two directional trades, which ended up being working out pretty well, good fundamentals. But this is number one, which is something that I think I did wrong. Instead of capitalizing on it, I just kind of, I opened it on a demo account and kind of followed those positions this way, instead of opening them maybe with a very, very small amount of capital on a real account. Now, next thing is I didn't factor in the call and put skew when deciding on a position. And for those who don't know, call and put skew is basically when calls are much more expensive than puts, or the other way around. In this case, calls were much more expensive than puts, which means the market makers are pricing in calls to be way more expensive, which means there's more risk to the call side for the specific products where the call and put skew is really big. So this is something I probably should have also looked at. Obviously, I do look at it, but I decided not to factor in when I open a position. But that's a big one as well. I want to be looking at that, and because this can give me a hint where all the risk is. And sometimes the call and put skew is so extreme, where calls are so much more expensive than puts, where clearly there's a lot of risk to the call side, right? So in that case, maybe I don't want to trade. I don't want to sell any calls at all. I don't want to have any risk to the upside, right? So something definitely to keep looking at if things, if the next year is going to be as crazy as this one for commodities specifically. And last thing is I traded mostly 80 DT or more, so 80 days to expiration. I think it wasn't the best decision. It was okay. It wasn't like a mistake, but it wasn't the most efficient way to get the returns that I got this year, because I could have done pretty much the same thing with much low risk, or even done a bit better with much low risk by choosing different DTE. Now, lessons learned going into 2026 is I want to capitalize on directional opportunities, mainly short puts. I want to wait for a pullback before entering a position, and this is only if price had a strong update, of course. This is something I haven't done, and this is, it gave me a tough time. Overall, it worked out okay, but again, I'm trying to improve. I want my efficiency to go, to be at the maximum level. Now, if the call and put skew is extreme, calls are way more expensive than puts. I want to avoid having any exposure to the call side. We just talked about it. And last thing, I want to stick to 45 days to expiration because theta is extremely large. Vega is smaller as well. And this will further reduce time in the market on overall exposure. So what we just talked about with 80 days to expiration, the only caveat that you really get is you get extra theta, but you also get the options are also more sensitive to Vega, which is problematic, of course. So 45 days it is, and whatever credit there is, it's what I'm going to take and work from there. So let's go over the broker statement, my risk measures for the Sharpie ratio and so on, and just a few more things on the graph that I want to show you what that I've done well, and basically what that I've done not well actually, and what I could have fixed, and very simply. So let's take a look. This is my return for the year, so it's 25.93%. You can see over here, and the date is obviously January 1st to December 30th. So this is the broker statement, and this is the risk measures for my account. So you can see the date here. So it's the 1st of January 2025 until 2026. Sharpie was 2.58, and max drawdown, I think it's actually a bit more than that. I think it's 2.8%, but maybe I'm missing something, but this is what the report spews out. And you can see everything else here, but this is basically it. There's nothing too much to it. Now let me show you a few things that I did wrong, and then opportunities that I've taken them on a demo account, but obviously it doesn't count as much. But just gonna talk about why I didn't take them, and obviously it was all directional trades. So this is a trade I actually took. It's on copper. It was the last trade of the year. I opened it right here on December 11th. I was a 4.9 put for copper, and I opened it on this. Basically, this is a pretty big update for copper, right? So the position was opened when the price was basically all the way up here for the most part. So this is obviously not a good time to open a position. Obviously, price could have gone up like even more, but this is not a concern of mine. I want to make sure I get a good entry. So you can see just waiting for a pullback just the day after, I could have opened the position and be profitable much quicker. It worked out either way, right? And it's really hard to time the market, but there are a few things that you can do to just better your chances at profiting much quicker when you sell options, right? So this is one of them. Definitely, you don't want to sell when there's the prices at a recent high. You definitely want to wait for a pullback, even though it might continue up. It is what it is. If it's a missed opportunity, then it is what it is. I want to make sure I minimize the P&L fluctuations on my account, and obviously entering the position over here and having this massive down day right after is not gonna look on the account, not gonna look good on the account. Doesn't matter if it's worked out or not, right? This is the one thing I should have been more patient a bit over here. Now I've had a position on crude oil where the entry was pretty good. I don't think I can find it here right now, but the entry was actually very good. I think the entry was on this day, September 9th, I'm pretty sure. I might be wrong. It might have been, but it's been somewhere here. So the price has been moving kind of sideways, and I've entered basically at the middle or closer to the bottom of the small range over here. And then the price fluctuated, and I ended up profiting. I remember the full profit on Friday, September 26th, because the price kind of went up. But the entry was good, right? So a few things that I've not missed this year, but were really fundamental. So you can see here there's a big surge in price over here, and this is basically after the I think it was the 23rd or 24th, where two representatives from China and from China and the US, they talked about the US-China trade deal before Trump has had a meeting with President Xi, and they agreed on a few things, and they both obviously it went all public. I think it was the day before, actually. I think it was on Thursday, so there was plenty of time to enter on Friday. And basically, they agreed that China will buy a substantial amount of soybeans from the U.S., right? Because China is a pretty big purchaser of U.S. soybeans, and they haven't been buying anything for quite a while because of the ongoing tariffs and the trade war. So here it's a clear opportunity where you can sell a puts somewhere over here, and maybe even lower depending on the credit, but somewhere below this low over here, and clearly have a pretty good upside. Now the price hasn't been like closer to the bottom, but here I would not expect a pullback on these kind of big news, right? So this is a bit different, and plus the price hasn't broken out. Now Trump and President Xi, they had a meeting on I think it was the 30th or 31st actually, I think. And at this point, they confirmed what has been said on the 24th, but it's too late, right? The price is multi-month high. It already broke out. I don't want to enter a position here because I've already basically kind of, you can say, missed an opportunity right here. Even though I ended up opening it on a demo account, but obviously I wasn't 100% sure. I don't trade directional too much, right? So this was one thing. There was a few more. There was a trade. Let me see here. When there was a mine collapse, a pretty big mine collapse. I think it was September 24th. I'm pretty sure it was a pretty big mine collapse for copper, and I think the news were that it will take up until 2027 for this mine to resume full production, right? And this mine was responsible for 3% of the world supply of copper. So this was another opportunity that I took on a demo account because, again, I'm not used to entering those new directional positions, so I decided to just kind of play it safe. But at the same time, I just kind of wanted to avoid this kind of stuff, right? And then I could have either probably waited the next day, see what's going to happen, and then enter the position, which we had this little pullback, and obviously price kind of went up and up from there. So this is just two opportunities. There was like 3 or 4 more similar opportunities where they're really, really simple, quick plays, and fundamentals are just supporting a certain price action. But obviously I ended up not taking them on a real account. So I do expect 2026 to be a pretty good year. Going forward, I have way more, I guess, knowledge in terms of directional trading, and the biggest thing is my analysis they were always correct. Like I've never had, at least for the directional trades, they were always correct. Now I've had one loss this year. It was on a gold position, so it was a short strangle. I opened the position, I think on, was it? It was November, right here, I believe. So November 3rd, I opened it up. Within a few days, it was up 30%. And then we had the next weekend coming up where the government shutdown was, it looked like it will be done. There will be some economic data released that will support a rate cut. A rate cut is very bullish for gold, right? So price went up like crazy in this one day, and I basically ended up closing the position here for a loss of about 2.8% on the entire capital. So small loss, or normal loss, not outsized. And price kind of kept going higher and then down, but obviously it ended up going up and up and up at the end of the day. And it was a short strangle, right? So I had exposure to the call side and to the pull side. This is where the skew was so big on the call side. I think the total credit that I collected on the strangle, 80% of it came from the short call, right? So this is a really big skew, and this should have been a pretty big red light for me on its own. But it is what it is. I ended up taking the loss and continue, and just gonna go through it and go up to the next trade, which was the copper trade where I profited. But this is it pretty much for the year. I think it was a pretty good 2025. Could have been better, like always. It's always going to be the case, but I think I did a pretty decent job, giving the P&L fluctuations that you would have had, or a lot of people had, especially what happened with April, with this massive down move, and April 2nd, obviously, where a lot of people lost a lot of money. So I think I did pretty well considering the kind of year we had. So thank you again. If you have any questions, let me know. If you want to join my free private Discord, email me with my email address below in the description. And that should be it. Let's have a profitable 2026 and see what we can learn and do. So thank you again, and I'll catch you in the next one.